Hey everyone, and welcome to today's NSITSP Cyber Series. Today we're happy to have Ben Yarborough from Calyptix talk to us about the importance of cyber insurance. He's got a lot of stuff to cover, so we'll dive right into this. So a little bit about the NSITSP Cyber Series. We've been doing this. This is actually our anniversary month of the Cyber Series. We started in December of 2024. We've covered topics like the NIST cybersecurity framework. We've done CIS framework. We've done shared responsibility models, HIPAA. We've gone through all kinds of cybersecurity topics. Today, as I said, we're going through cyber insurance. Next month, we're going to look at cybersecurity safe harbor laws and why those are important. We're going to do a CIS update coming up in February, and then we'll be looking at international threats. So keep tuning in month after month on this. These are really action-packed series. So please keep coming back. A little bit of logistics on today's topic, or on today's presentation. Please use the chat window to put any questions you have of Ben or the topic in general. And today's webinar is being recorded. It's available on nsitsp.org website. It'll be available in a couple of days, and it's available to NSITSP members. So why would you become a member of NSITSP if you're not a member today? Why would you join? Well, we are a voice, for the industry. We advocate for the IT service provider industry and MSPs. So if there's something coming down the pike of taxation or regulation or something that would be beneficial, we're there to forge connections with legislatures and local communities. We also want to make sure that the professionalism of the industry is maintained, like doctors and accountants, that we really up our game, that we follow a set of business ethics, that we build value into our services so that we can command those higher rates that we all want. Finally, we want to build a community where you can learn from experts and through webinars like this, blogs, things like that, and share your best practices with like-minded colleagues. So if you're not a member today, please go to nsitsp.org/join and join today. Again, as I said, we are happy to have Ben Yarborough from Calyptix talk to us about cyber insurance. And I'm going to let Ben introduce himself because he's got a great background, and I don't want to steal his thunder. So with that, I'm going to sign off for now and hand it over to Ben.
Mark, thank you so much for the invitation to present today. And looking forward, I'm going to see if I do this proper. Let's see. Hopefully that's showing up properly. So I am CEO at Calyptix Security. We're a network security company that works with MSPs to serve the small business community. I'm also a lawyer, and I maintain my legal degree. And so I've done over the years some blog posts, some presentations, drafted MSP agreements, and really tried to leverage my experience from a legal side to help our customers and partners and folks to understand. And really the escalation of cyber insurance and the rise and role of the NSITSP is really aligns very well. I mean, as the professionalism of the service escalates, the need to organize with like-minded folks to elevate the standards and communicate that to the customers is really impressive. I do want to put one brief shout out. We have a new service called Community Shield Plus with OpenText. It's an easy to implement MXDR service, covers O365 or Google Workspace. Your network data is easily integrated from our firewalls, a lot of threat intel there, and then endpoint detection. So it's easy to set up, easy to implement, and it provides great alignment and access to experts with a human-managed SOC. So let's get to the topic. So why is this important? I have a lot of slides. I'm going to move quickly. So obviously, I think most importantly, there's great opportunity with the elevation of insurance for small business with cyber risk, but there are also a lot of pitfalls. So understanding and navigating it and knowing what you're comfortable with is key. There are a lot of resources to tap into, but number one, go into it eyes open and don't purport to be an expert if you're not. So the industry today is massive. It's $15 billion globally or more, and it's growing. It's the fastest growing property and casualty segment. I would note one of the most important things for the small business market is that the top 50 insurers in cyber cover all but $100 million of written premiums. Let that sink in. So the bulk of the business is done by the top 50 underwriters. That means the small guys, they may serve you well. Uh, there's likely a lot of variance in that small business segment. So shop around, get to know the different players. Don't think they're all the same because the big guys hadn't figured out the small business space. So anyhow, understanding how small the underwriters are that are really serving, I think a lot of the small businesses are key. It is fast growing, and unfortunately, the biggest trend is growing losses. That means narrower coverage, more conditions, more premiums, and likely more litigation and more denials. So the history of insurance is important because insurance is essentially using pooled risk mitigation to offload financial risk. So it started with ships setting sail, and they would try to insure the return of the cargo. And if the ship sank, then the investors for the ship got their money back. If it didn't make it, if they made it back, they got the cargo there and they made their money off the cargo. That ultimately evolved to Lloyd's of London, which really was a coffee house where folks got together and they would underwrite, using personal wealth, risk of business ventures. So today, insurance is very structured. It is very regulated and very focused on unpredictable financial risk through licensed insurers. They're important to identify key parties. There's some legal requirements in order to get insurance. It's called an insurable interest. It can be overlooked, but in order to get insurance, like life insurance, that means the life of the person insured is the insurable interest. The business operations are typically what would be insured with cyber coverage, right? And there's a process for underwriting disclosures, and underneath it all, there's an operational requirement of good faith. And that good faith standard is imposed on the insurers, but likewise, the insureds or the applicants must also abide by standards of truth and accuracy and so forth. So, because if the underwriters can't define the risk, if there's lack of transparency and understanding, then it totally destroys the ability to provide the financial risk transfer. Scope of coverage, first party, third party, I'll get into that. There are also specialty lines like the M&A indemnity coverage. Leave it to private equity guys to figure out how to get their money back faster. So instead of leaving money in escrow, they'll buy a policy that's less than the escrow, and the insurance company will take the indemnity responsibility for the private equity firm so they get their money faster. There are critical documents in coverage: the application, the declarations, and the insuring agreement. And additionally, it's important to note that disputes are often litigated. Courts and judges have really serious frameworks to interpret policies and resolve disputes through litigation. Obviously, it's about money, so money gets litigated. Parties and roles. It's really important to understand that the three key parties from the insured side are the policyholder, the person that buys the policy and owns it and pays the premiums, the insured, who has the insurable risk, and the beneficiary. So the beneficiary is typically the person that pays the money. And depending on the type of policy, these can change. If you think about a life insurance policy, the company, Calyptix, can take out a key man insurance policy on me. So Calyptix would be the policyholder and the insured because they have and the beneficiary, I'm sorry. But I, as the life, have the insured life would be the insured. Also, there's the broker, who's the licensed party selling the policy, who not only sells it, services it, but helps the insured or beneficiary recover. And then there's the insurer, the person that takes the risk. Behind them, there's frequently a reinsurer. There's a huge market for offloading excess risk. And so it's a very complicated, layered industry. In terms of documents, the application, which most MSPs are aware of, is part of the contract. It is not paperwork. It is probably one of the biggest risk pieces in getting policy for an MSP. And I'll show you some cases. A false statement there equals denial or potentially policy revocation. And if the MSP is the one completing that application, then think you don't have risk in that process. You may want to rethink that. The declarations is a document that says specifically, when does the policy begin? What entity is covered? What specific lines are covered? What's the limit or deduction and maximum amount? What's the coverage period? Is there a tail? Is there a retroactive date? So the declarations is sort of really the critical piece of, do you actually have coverage? No deck, no coverage. Insuring agreement, the nitty gritty of the terms. That's all the definitions, the insuring agreement, qualifying events, and all of that. So when you get into the details, there's typically what's called an insuring agreement, which is the core promise. If X happens, we pay for this loss. So there are definitions that cover the breach, the claim, the loss, the incident, who's the insured, what a computer system is, discovery. All these are really key definitions. And for big firms, they tend to track the same. For smaller firms, underwriters, there may be more variance. And in third-party warranties, I have no way really to gauge, but I'm guessing they don't follow traditional language from insurance policies. Limits and retentions are just the maximum amount and deductions. Exclusions, very important. And I'll go over how much of cyber has now been excluded from traditional lines. And then lastly, there are other conditions, particularly for cyber. If you say you have multi-factor, then not only do you have to have it at the beginning, but you also have to maintain that condition in order for the coverage to apply. First party coverage. And I'm trying to just get through a lot of the background here to get to some of the major pitfalls. First party coverage is paying for the insured's direct damage or loss. This typically means the policyholder is the insured and is the beneficiary. An example might be a direct loss by ransomware by the insured. Third party coverage is when somebody else gets hurt by the first party's breach. So for instance, if a hospital loses the healthcare information of the beneficiary, then they have to try to cover that loss by providing, credit monitoring and notification and things like that, right? So that's typical, or also might cover PCI liabilities and fines, where the merchant has now got to pay for violation of regulations. So years ago, before where we are today, the cyber losses were silently covered. When a company loses a bunch of money to a cyber incident, and the definition of personal injury or property damages doesn't really exclude data, and maybe the court can say, you know what, data is kind of like a real thing, right? I mean, it's bits and bytes. Even though it's electronic, it does exist somewhere. So you know what? We're going to cover it. We're going to cover it on a general liability, or we're going to cover it on a property policy or crime policy. We might even cover it on a director and officer policy, say if somebody gets socially engineered or business email compromised. So that happens, and the dynamics of that are always interesting. And I took an insurance law class with a professor, Kenneth Abraham, and we really focused on environmental law back in the 90s, because that was the newest type of insurance in the 90s. And it talked about how even then environmental coverage happened the same way. It originally was covered inadvertently by traditional coverage lines. But guess what? When the coverage gets too much, the insurers figure out how to exclude it. And so they exclude expressly electronic data from general liability coverage. They exclude the definition of data from tangible property. So now it's not covered in property policies. They exclude fraud, financial money transfers expressly from criminal policies. And they limit E&O and D&O to only professional service type policies. So really, what's happened is this has occurred over the years, and an example of this is the Alaska Frontier Constructors case. Now, this only happened in 2024, but it's probably because their policy was pretty old and they were just renewing it. But there was an exclusion for data and privacy, and there was a business email compromise event. There was an unusual twist in that Alaska had some specific state statutory provisions around exclusions. So it gave Alaska Frontier some standing and basis to bring the claim. And so they did. The coverage was denied. They sought coverage and they lost. And it's clear at this point that if you have a cyber exclusion on your liability and property type coverages, it's going to be excluded. This is important for you as MSPs because your customers may think, well, I have insurance. They do, but not for cyber. And when you look at it, cyber is now its own market because of the severity, the volume of losses, they're just massive, and the frequency and the ambiguity. And then, the reality is if you get to court, if you're able to survive a summary dismissal by a judge and get in front of a judge and a jury to make a claim, the court's going to rule narrowly against the insurer and more in favor of the insurance, the insured or customer. And so as a result of that, the regulatory and industry folks said, you know what, we got to write this out of our policies. And if you want to buy it, you get a standalone cyber policy. So rest assured, if you don't buy it separate, you don't have it. So another policy that has now emerged is the MSP technology E&O policy. And I'd like to describe that as almost a malpractice type policy. That is really if there's failure of professional services that create liability to the MSP, for instance, a backup fails, a patching doesn't happen, or some other security event occurs, it's not going to provide any protection to the MSP other than likely defense cost or settlement cost. If you have your own ransomware incident or breach that leads to a compromise of your customers, MSP technology E&O will most likely not cover your own recovery at all. But it will, it will help restore your end customer financially. The reality is most MSP technology E&O claims are going to arise with a cybersecurity incident. And the reality is because there's no harm, no foul, right? It takes a recognition that there's an actual issue for the coverage claim and a loss to occur. I remember learning that, you think medical malpractice is always results in a lawsuit. The reality is it doesn't. I would say only 1 out of 10 malpractice events occurs in a lawsuit. And that's because the patient, maybe has to stay in the hospital an extra day. Maybe they need a little extra tender care, but the damage is not so bad that there's a claim. So managing that impact to your customer, I want you guys to realize that how you work with your customers can be your number one risk mitigation strategy for bad outcomes for your customers. If you go into warpath, hostile, not good business partner mode, you're more likely to have a claim than if you're trying to do everything in your power to restore your customer. The other kind of policy that's emerged is the hybrid, which includes a combination of first-party coverage for the MSP as well as technology E&O coverage. The ones that I got my hands on all seem to be a little different, and they all seem to come from smaller underwriters. So I think it's important if you do go down the path of a hybrid policy, which might make very much sense, that you really understand what's covered, what's not, and that you differentiate between, your own loss, a la ransomware, versus an incident that you have that causes a loss for your customer. So I tried to help articulate here how you might layer coverages. So the first 2 lines are an MSP first-party cyber policy, in which case, if you had a ransomware event, you might have a claim for coverage. It's not going to cover your customer for malpractice and that type of thing. But if you had sort of a privacy breach that impact third-party beneficiaries, that may typically be included. And likewise, if the end customer has a policy and they have a first-party breach, then they're going to have first-party coverage and third-party coverage for others. Likely no coverage for the MSP. And that coverage, not only is it loss, it's also cost of defense. So, forensics and the like. So if you want your own cyber policy, first party policy, owned policy where you're paying the premiums, you're the named insured, the name owner, and you would be the named beneficiary for first party coverage. The technology E&O, again, is really limited to the malpractice claim with the limited note of defense cost. Hopefully that's a helpful chart. I would encourage you to think about navigating the cyber policy landscape as an opportunity for not only risk reduction, but also helping your customers and growing your business. One path would be to look at your own cyber policy opportunity and see what it requires to get it and build a broker relationship. Then evaluate the tech E&O coverage. You may or may not decide to do it. That's up to you. Because there may be other loss protection measures, including effective terms of service, policies and procedures, and the like. And lastly, help your customers and navigate their own cyber policy. If they have it, you need to be involved with it, just like any other regulatory framework. So whether it's HIPAA, PCI, or a cyber insurance policy, it is an imposed mandatory standard your customer needs to satisfy. So you need to assist them with qualification and review, make sure you have visibility, and it serves as a validation of what you do as an MSP in terms of securing their environment and putting the right controls in place. So now the pitfalls. So hopefully I've left enough time. Yep. So this was really interesting, going and finding cases that really nailed home these points, right? So the number one point is policy definitions and details. And this is sort of like, the details in the code, in the packets. It's in the policy insuring agreement. So critical definitions that you might want to watch would be discovery, because that's when the client is imputed to know whether they know actually or should know by conducting, ordinary reasonable practices of a breach. Then that triggers certain obligations. It triggers obligations to notify the insurer. It triggers obligations to minimize or mitigate loss or damage. And so that concept is really, really important. But in this case study, I'm going to focus on another definition. So this was a case study of a payment, fraudulently induced payment. And the customer had clear coverage for fraudulently induced payment. And that's also known as social engineering fraud. And it required loss of funds, good faith transfer by the employee from the own account, a fraudulently induced instructions like a phishing mail, and that some arrangement or contract with a vendor for goods and services. If I had a poll, I'd let you guys guess which one of these variables was the killer. Anyhow, the takeaway is the wording matters and it will continue to evolve. And it's like understanding the nature of your business and then the nature of the client's business and the nature of the terms is important. Because in this case, we're not talking about, a small business. We're talking about Baird Investment Group. They are a very large Robert W. Baird company, bought $29 million worth of bonds from White Lake Township in, I think it's Wisconsin, maybe. They got 24 million back. They basically got fished. They wired the money to the wrong guy. And they got 24 million back, but they were out 5.1 million, right? So they had two social engineering fraud policies. Their primary policy was with AIG. It had a $2.5 million limit, and they paid up no problem. Chubb, on the other hand, which is another name for Federal Insurance Company, they said, we're not paying because we underwrote the provision of goods and services, not the purchase of securities and financial instruments. So there was a loss of funds. There was a good faith transfer from the own account. It was fraudulently induced with a phishing mail. But Chubb is hanging their stake. And again, this is the case that was filed in October on the provision of goods and services. It's going to be a tight case. These are big boys. It's expensive to litigate. We'll see what happens, but the devil's in the detail. So another pitfall, I think this is probably very real and very sensitive for MSPs, is the application. So I went and dug through a variety of applications, and I found the travelers to be really interesting because there was so much information. They asked for your data inventory, what type of data, how much data, is it encrypted, is it regulated? And then they ask about all these different privacy controls, network security controls. Do you have the payment card controls, other liability controls, and so forth, vendor controls? And this checklist, it was extensive, and it's online. You can get the traveler's application, and there's a lot of information here. So in this case, travelers denied a claim submitted by International Control Services from a 2020 ransomware scenario. And specifically, Travelers requires a separate MFA attestation with the application. And of course, they checked, yep, we use MFA. And you dig into the actual attestation component, which is a 3-page separate document just for MFA. They say, do you use it for email and remote network access? Does the admin have to use it for local and remote access to all systems, network, endpoints, and servers? So again, any admin access has to be covered by MFA to any system by any person or party, including MSPs. So understanding what the customer is attesting to is critical because they were clearly a victim of ransomware. They had MFA, but only on their firewall. So guess what? They got denied. Not only did they get denied, the whole policy got rescinded. So that's like a slam dunk in insurance world. So what did we learn? MFA is one of the top targeted items for insurers and rejections of claims or disputes. So if your client is, attesting to MFA usage, make sure you understand precisely what it's covering. Leave time to get all the facts, ensure the disclosure matches reality, and make sure that it likely covers your guys' access to their systems. Identify all initial requirements in the application, as well as any ongoing requirements or covenants required that they maintain these controls. And incorporate this with your onboarding of new clients and document and retain any role you have in completing an application. Now, in looking at the applications, I found that they can be very tricky to complete. Some may only have do you do monitoring or a SIM? Some may specify vendors. Some may say, hey, you have to do it by VPN. So they omit things like zero trust network access, which is more secure than a VPN. It's like we have a tool called Gatekeeper on our firewall. It's a zero trust patented access for RDP and SSH. But so you got to be careful about the applications. Work with the broker. As a lawyer, I would advise my client to really detail any response, mark it up, submit a memo, document policies and procedures, and see attached appendix, right? Don't just check the box. Provide complete transparency on the controls because that positions the insurer, in a tougher spot. If they write the policy, you've given them exactly what you're doing. And, additionally, I found that some of the policy applications can be vendor biased. And what they're trying to do is obviously offload the risk by raising the requirements. And some customers, at the end of the day, they may not be able to do or afford everything that's required by the policy. But you can use the application as a guide or a benchmark. Before you run Get Policy, make sure you at least qualify, because there may be more cost to getting the policy than just the premium. So this next topic is called subrogation, and it's very much a legal term, and it's a gotcha. So subrogation is the concept when the insurer pays for a loss. They have the contractual right in their policy to step into the shoes of the customer or the insured and to pursue anybody they think is at fault. So the way that works is, they'll settle the claim, they'll pay the customer off, but then they're going to do a thorough investigation. In a construction claim, that a fire, my parents had a house fire, and they give them a questionnaire to ask, and like, hey, did you have anybody do any work on the house? Did anybody do any electrical work on the house? So what they're really doing is fishing for a third party. So one, they're fishing for somebody with liability, and number two, they're fishing for somebody with resources. So this is probably one of the biggest targets for MSPs is subrogation, and it's on the table now. And it's starting to get more aggressive, because if they believe they can recover from somebody else and their resources there, then they're going to come after it. Potential targets are MSPs, IT vendors, cloud providers, payment processors, anybody in the chain. I would say MSPs have it the worst. And the reason they have it the worst is because they're providing a service. They probably have looser terms. And they probably have closer to a duty, like a professional service duty. Vendors are hard. I mean, like, look at CrowdStrike. I mean, they were able to limit their liability with their end user license agreement and the like. So it's a real claim now. So in this case, Ace American Insurance Company paid a $500,000 claim for CoWorks, a staffing company. And now they're going after Congruity 360, an IT firm, and TrustWave, an MDR SOC cybersecurity firm. And in this case, they have outlined the legal claims: negligence, gross negligence, breach of contract, breach of implied warranty. They're asserting the same claims against both parties. It's interesting to note that the facts underneath them are slightly different for each. So guess what? For Congruity, if you had to guess what the basis of the claim is, multi-factor. They were supposed to have multi-factor on an FTP server that was hosted in their data center, and they didn't. It was compromised. It led to the ransomware. So one of the key critical elements in any of these claims is failing to do something you should do. And why you should do it could either arise because you contracted to provide that service, or you have a duty of care, which gives rise to the negligence claim. I've got some blogs back in 2020 or 21 I did on standard of care and negligence, but that's starting to actually 5 years later to see the light of day. And essentially, it's establishing a professional service responsibility and failing to fulfill that standard of care. And that failure directly leads to a loss for the customer. So in this case, what we've learned is that MSPs and the service providers are very much a target. As I mentioned at the bottom here, the insurers view the MSP as a professional, and I agree. I think you are. And you have a standard of care that you need to maintain, and that's what the NSITSP is committed to helping elevate and make aware. There's nothing wrong about a professional standard of care. Doctors have it, lawyers have it, accountants have it, a lot of people have it. If you want to professionalize and elevate your business, MSPs in theory should have it too. And so understanding that and when it's going to arise. So typically business email compromise, failure to implement the MFA. Ransomware, failure to patch, right? Ransomware, failure to segment firewall rules or, misconfiguration, bad onboarding processes, the backup doesn't work. So, it can fail, that's fine. But if you have a process where you're testing it and it works on Monday, it works on Tuesday, then you have ransomware and it fails. It's okay if it fails, but did you have a process to minimize the risk that it would fail, right? So really protecting yourself against these claims is one, knowing where the risk might come from, and then implementing reasonable process procedures and controls. Social engineering. I think this is a really, really good topic to help highlight the difference in coverage lines, and also an opportunity for MSPs to be a advocate for your clients to get more protection with training, practice, and procedures. Because social engineering fraud is expensive and it's getting much more expensive. So why spend too much money on policy when you can train your people on how to prevent it, right? So the application again highlights the differences in two lines of coverage: fund transfer fraud, social engineering fraud. Each of these lines has a separate insuring agreement. And each of these lines is priced separately, has separate definitions, has separate terms, and has separate retention or deductible amounts, right? In a computer funds transfer fraud, what that covers is a technical compromise, typically, where a hacker gets access to a system, creates an authorization for a transfer of funds that is not otherwise authorized. There's no knowledge or consent by the party, and the employee doesn't actually transfer the money, right? So it's a real hack, if you will. That is a covered computer and funds transfer transaction. On the other hand, a social engineering fraud is the one that gets all the attention. It's frankly easier to execute, and it's more expensive to cover. So this is, again, that intentionally misleading of the insured. They transfer money to a person. There's good faith reliance that they, are transferring a legit payment, and they're trying to pay a legitimate obligation, right? It's not wiring money for the Panthers suite that Calyptics has, because we don't have a suite, and everybody here knows it. So if it's not something you normally have, you can't, if there's not total good faith across the board, you're not going to get coverage. So the most common of these, obviously, is the business email compromise, changing the wiring instruction, pay a bill that's not really a bill that's due. So there's been a lot of cases on this. Abraham versus Spinnaker. Oh, I got a typo in there. But Abraham was 2 million versus 1 million. They had 2 million of fraud transfer coverage and 100,000 for social engineering coverage. Guess what? They only got social engineering coverage because that's what it was. Same with the Lloyds of London versus Gailey. They were limited to their social engineering limit. Interstate removal, they were limited to their same thing. And then City of Aurora, similar as well. So that was a municipality. And so we got a lot of good cases that if it's social engineering, that's a line and it's not covered. So the opportunity here is to understand your client's payment processes. I think it's important to understand it's how they get paid and how and who they pay. It's the money in and the money out. Because in a number of these claims, it's actually the vendor that's supposed to be getting paid that gets defrauded. And if your customer pays the wrong people, not you, are you going to sue your customer to get their money, get your money? So that's what a lot of these claims have been about. It's not just your customer paying the wrong people. It's your customer's customer not paying your customer, right? So understanding that dynamic and having policies and procedures around your customers communicating with their customers. Hey, this is how we tell you to pay us. And, don't believe a change. Call us at our number. There's a lot to help here just around on training, whether it's phishing training, but make sure the phishing training is done by the right people, right? If somebody doesn't have authority to make payments, then they're less of a risk for this type of fraud. But if somebody has wire transfer authority, they need to be on extra high level social engineering training. They also need to know the exact limit of the social engineering fraud transfer versus the other transfer. And they make sure they don't mistake one for the other. Because when they realize their limit is $10,000, that means any transfer over that, they should be extra careful about, right? So this is a huge opportunity to illustrate the difference in these transfers. And it's important to note, this is a little bit about insurance litigation. So there's a thing called an outlier, right? I love this because I like fishing. But this fish is not only is he red, he's going the wrong direction. Well, that's what happened in Kane v. Beasley. In this case, it was actually a community healthcare, New Mexico Health Connections, which is now insolvent. I don't know if they're insolvent because they got hacked or not, but they literally did get hacked. And there was some, their mail server got hacked, and ultimately they paid the wrong people instead of paying their pharmacy consultant vendor. And somehow the judge said, this kind of looks like a security breach. And, if it was direct or indirect, it doesn't really matter. There was a security breach. Yeah, you had the limit for 250 on social engineering fraud, but this was still a breach. And, it's a healthcare company. So they say bad facts make bad cases. Well, this is exactly that scenario. So the judge said, we're going to give you liability under a general security breach. So that escalated the claim, and the insurers hate it, right? I mean, they gave the company coverage for social engineering. They had a social engineering claim, and the judge said, yeah, we're going to go ahead and give them more. So what does that mean? So they'll pay it, but insurance is not a one and done. So just like the definition of the dispute over goods and services, they write policies, they have claims, they litigate claims, judges make decisions, and guess what? They get to do renewals. When they do renewals, they change the terms. They modularize the definitions like I was showing you, and they get 12 or 14 different lines of policy. They get tighter causation language. So it's solely resulting or directly resulting, not including, but notwithstanding for this, or expressly excluding anything that would otherwise be covered by these other lines, right? And so coverages are going to get more expensive. Coverage is going to shrink. And it's just understanding that insurance is like this process. They're going to make money. They're going to raise premiums, shrink coverage, use the cases to refine the policies. Same thing happened in environmental law. Same thing happens in cyber policies. So one last thing I want to raise is a delicate one because in our space, we see this, vendor warranties. I think honestly, as MSPs, you're a trusted advisor to your customers, and you need to be in a position to differentiate between objective advice and sales and marketing. So warranties are not financial risk transfer contracts. They are not regulated for fairness and solvency. They are not subject to a good faith requirement of the vendor or the warranty provider. They are not subject to traditional judicial scrutiny that tightens the screws on the insurer. They are not sold by licensed insurance agencies. Warranties are product and service guarantees, just with a dollar number put to it. They are sales and marketing tools. They're designed to drive product sales and escalation of service levels. They're designed to drive vendor stickiness and validation. They're very carefully tailored and limited, and I've reviewed a number of them. They impose product conformance. They are ad hoc and very vendor specific. Third-party warranties may have a place in your portfolio. Do not substitute them for cyber insurance for yourself or for your customer. Why? Because you're likely to become the target. Now, here are some red flags when looking at warranties. Do you have clarity of the contract? Do you know who the parties are? Do you know the difference between first party, third party? Do you know how a claim is actually initiated, processed, and controlled? Does it only apply if the vendor product fails? Can you attain the configuration requirements to fit into the harbor of coverage? Does it restrict you to only their services? Do they exclude common attacks and losses, or really only cover ransomware, right? Do they impose low payout caps set by the vendor, notwithstanding the actual financial risk of the customer? Do they subject you to cancellation or changes at any time? So policies, insurance policies, when an underwriter writes a policy, you got that policy for a term. They can renegotiate on renewal, maybe. So that's like that Alaska case that's a 2024 case on an exclusion provision, but that policy was in effect, and really there were some things in the law that prevented some changes. So it gave that Alaskan company a better leg to stand on. So that wasn't supposed to happen. So anyhow, I really, of the takeaway, subrogation, over-reliance on vendor warranties, I think are really big pitfalls. So the other piece, if you think and you convey to your customer that you've got a warranty and therefore they're covered, your customer is going to rely on you. It likely could be argued that's a misrepresentation. It's likely that could lead to professional liability risk. If your customer relies on a vendor warranty and omits pursuit, at least investigation of their own policy. So the warranty, don't utilize that and prevent the customer from making their own decision. Warranties are one size fits all. A brokerage firm that's wiring millions of dollars may have enormous social financial fraud transfer risk. However, a nonprofit, they don't really have much risk there because they're getting money. They're not paying out money, right? So it's you need to make sure you work with your customers to design the right financial risk coverage for them in consultation with their counsel, their advisors, their broker, and you as the technology person. I just think the reliance on vendor warranties has a potential to be a really significant challenge. So what do? Make lemonade, right? There is opportunity here. In fact, there's enormous opportunity. But you got to start with the risk mitigation. That means you first have to evaluate whether you should have your own policy or your own tech E&O policy. You may not need it. You may decide you can't get it. You may decide that it's too expensive. On the other hand, I've seen some quotes that aren't that bad. But then you look to other mitigation measures. You standardize your onboarding process to match the application requirement. You make absolutely certain you get a copy of a policy, an application, a declaration page. You also make sure that you manage, participate in the application and renewal process. You need to build in an incident and notification protocol that's aligned with the insurance conditions, or you give that as part of your memo to the broker that you give to every broker, the same broker, of what you do, your process and protocol, so the applicant can just attach it to the application so that when you follow your process, it will be consistent with what the underwriter underwrote. Again, avoid overstating and over-relying on vendor warranties. Ensure your terms of service not only limit your liability, but limit insurance-driven denials, that you are not responsible specifically for a denial of coverage. Require in your contracts that you get notice of any insurance change, any renewal, so forth. There's a concept called waiver of subrogation. It's common in construction. What that means is that if you're a third-party sub, you ask the insurer of the general contractor to waive subrogation so that they don't stand in the shoes of the general contractor to sue the sub, the electrician, on the job. You can get a waiver of subrogation in some cases if it's done up front. The insured cannot waive their claims against you after they get insurance. So where that's going to come into play is if you go run and ask for a change of your terms of service after your client already has coverage. So there's some really technical coordination that could jeopardize coverage if they offer a waiver of subrogation without making the insurer aware. But then the opportunity. There are opportunities to upsell security controls, whether it's Community Shield Plus from our side for what we do at Calyptics, a more comprehensive monitored service, or it's moving from VPNs to Gatekeeper, Zero Trust. Utilize the insurance requirements to support, justify, and drive the value of what you deliver. Make sure that there's alignment. Don't sell an alerting service for alerts that you're not monitoring, because that's going to subject you to subrogation risk. Don't sell services that you say you do, but you don't do. Don't say you patch, but don't patch. Don't say you implement default deny outbound, but don't do it, right? I mean, that's where you get in trouble, is if your client has coverage and there's a breach and you're potentially on the hook and haven't performed as you've been required, you may expect a claim. And that's a reason to really explore the E&O coverage, because that can help you with the cost of defense. And that alone can be very significant. That alone is not covered in vendor warranties, right? So my price as a lawyer in 2004, when I left my law practice, was $450 an hour, right? And I'm not an insurance guy. So think about that. Cost of defense alone could put you under. So with that, I don't know if there are any questions or chats. I rambled. I think I got done close to in time. But hopefully this was helpful. Look for feedback and questions. Whew.
Thanks,
Mark,
Ben.
did I wear them out?
That was packed. That was really, really good. I'll
Yeah.
tell you, there was so much information in there. I love the concrete examples. It really it brings it home in terms of what all this means to customers and MSPs, and it just all the dimensions of it. There was so much detail in this that I hope people go back and watch this again to really understand all the nuances of cyber insurance and little things that I never knew about, like the granularity of the coverage based on the
Yeah.
type of fraud that's insane,
Yeah,
frankly.
that alone, I mean, a one pager. I've thought about turning some of these into one pagers for our partners, so that educating Dwayne, our director of support, was like, Ben, how do people prevent financial fraud with $100 bills? I mean, employees are trained to mark them with a pen, thoroughly vet them, right? So the opportunity for training there is really high, especially given the cost of that line of coverage.
Absolutely. Yeah. So let's see. There's been a couple of comments. See if there's any. Um, somebody's asking, MFA versus passkeys, are they the same?
That's a good question. I mean, I don't know enough technically about that. I think that's a combination of taking the specific requirement from a policy and having a vendor look at that and determine. I mean, multi-factor authentication is two requirements, right?
Right.
There's an argument that a VPN with a certificate-based VPN that also requires a password is multi-factor, but not really. It's like, so
Right.
passkey, if I'm guessing it probably would be given the adoption, but I don't want to go out on a limb there. I don't know it well enough, but I
Yeah, and whether the insurance companies are, technically up to that. I mean, passkeys are typically based on biometrics or something that you have, like MFA.
right.
So, yeah, it's interesting. So what is the best way to find a cyber insurance broker?
That's a great question. I have a contact at Marsh McLennan that I know could be available if folks would like. But his name's Bart McGowan. But I think there's some others that focus on MSP space. I reached out to a few. I didn't get any calls back. I think our firm that we use for insurance has a variety. One thing I think to be when you look for coverage, they're brokers that are monoline. That means they sell one line of coverage, and there are brokers that sell multiple lines. So, like Marsh McLennan is a mega brokerage. They'll sell Travelers, Chubb, AIG, Tokyo, whatever, Tokyo Marine. There are a variety of them out there. Um, I don't know. I know there are some that are focusing on MSPs. And I don't want to say good or bad. I truly don't know. I imagine they want to serve you and they want to learn and figure out what's needed. So I think that's probably a good place to start. But also, go pull the traveler's policies and compare it.
Yeah, that one seems to be the most detailed one I've ever seen. But yeah.
Yeah.
Um, let's see. There's another. What are three things that MSP should do tomorrow? Well, like, what's the top of the list for things to do?
Ooh. One is identify if any of your customers have cyber coverage. And if they do or don't, you need to know that. Do they think they may not know? They may not know, right? Just do a cyber audit, I mean, cyber insurance inventory of your clients. Hey, I'm trying to make sure that we can align our services with everything that you need. And then so that's the proactive, help your customers. On the flip side, you look at your terms of service. Make sure your own liability is limited, in your terms of service. Make sure, we refer to our end user license agreement, our partner agreement. It's incorporated by reference in every invoice we send, right? So you can stack your protections in multiple ways. But the last thing you want to do is somebody to say, no, we don't have a contract, right? There are a lot of ways to get a contract. You can have them sign a document. You can send them your terms of service and say, hey, before we start, these are our terms of service. And then you reference in your invoice, all services provided are subject to our standard terms of service, which were provided to you on commencement of service and are updated, upon request, right? So there are, multiple ways to get contractual privity, which affords you the opportunity to contain your risk. And the reality is you shouldn't be on the hook for $10 million social fraud from somebody, right? You can't protect stupid, right? And that's not your job. But on the other hand, if you do something that you should have done, it's tough, and then you try to limit it. So I think the CrowdStrike breach is interesting, or not breach, but I think there's some claims out there. There's litigation out there. How good is their user license? I don't think Delta's going to collect their billions of dollars. Got sophisticated parties, but a lot of it is positioning your firm, your people in a way that you can provide your help, but not get caught by an outlier, right? I mean, if they're paying you massive amounts of money, then maybe your coverage is higher. If they're paying you a little bit of money, doing the best you can. but stay informed. You can't stick your head in the sand.
Nice. All right. Well, we're just about out of time, so I want to thank you again for a really, really informative and just info-packed webinar. This has been a really, really educational session. I've got just a couple more comments before I close out, but again, thanks, Ben, and yeah, stay in touch with NSITSP, please.
I
Uh,
appreciate it. People have questions or feedback. I would welcome anything. Or if they're thinking, hey, if I had this, I'd love to help. So that's what we do.
all right, great.
All right. Thanks,
Um,
Mark.
Thank you, Ben. And everybody join us next month. We're gonna actually change it up a little bit. We're gonna do a panel discussion with the NSITSP Legislative Committee. We're gonna talk about cybersecurity safe harbor laws and why they're important for MSPs. It really ties into this subject because if you do find yourself in court because of something like this, cybersecurity safe harbor laws can really help out. So tune in next month on Wednesday, January 14th at 1 o'clock Eastern and join us then. So with that, I'm going to close this out and thanks everybody for joining and thanks again, Ben.
Thank you for having me.